This is the London Fintech Podcast, brought to you by your host, Mike Ballerman, bridging the worlds of suits and t-shirts, of finance and technology, bringing you insights, stories, and inspiration from the golden age of opportunity and innovation happening in London right now.
Hi, this is Mike Ballerman, and this is the London Fintech Podcast, episode 211, brought to you in association with Smart and theadministradboard.com. And I'm delighted to be joined today by Conrad Ford, Chief Product and Strategy Officer of Allica Bank, who are a business bank, or more specifically an SME bank, who got their banking license back in 2019. SMEs are, as I'm sure you all know, a super important part of all economies, albeit the sector that the Davos lot are all too busy attempting to crush. Witness the mass house arrest and closure of many SMEs during the COVID years, while the likes of Walmart, Amazon and UK supermarkets absolutely coined it. But, like everything else in this phenomenal realm, or at least in this phenomenal realm as processed by what passes for the human brain these days, any phrase has fractal complexity. What does SME mean in the first place? We shall look at that and what Allica Bank are doing in terms of lending to this vital sector later. Plenty to talk about, so let's go on with the show. Good afternoon, Conrad. Thank you for joining me on the show today, or rather me joining you on the show today as I came to you.
Hi, Mike.
Well, it's a pretty amazing day because not only have I done a real life podcast, one this morning, but I've done two in a day, which is the first time I've been efficient, I think, in 8 years, or maybe I did it once before. And the prior guest recording was in Canary Wharf, and I did something new today for the first time, in that I was coming over here and I left just about the right amount of time to get on the DLR from Canary Wharf to Bank and then walk up here. We're in Finsbury Square, only to find out when I got to the DLR that the DLR didn't exist. So the awfully named Elizabeth line, which I've never been on my life, I thought I'd see where that went. And it turns out that the Europe's largest infrastructure project, I read while I was waiting on the platform, a £19 billion line, actually whisks you from Canary Wharf to Liverpool Street / Moorgate, depending on which exit you leave, in about 2 stops and about 5 minutes flat. So amazingly, it actually works and is quite a good thing.
Yeah, it's almost as good as the Jubilee line.
Yes, well, the Jubilee line is one of the better ones, as train lines go. Anyway, I was wondering what we might start talking about. Now, listeners who are completists and who have remembered every episode will remember that in the past you've appeared once or twice wearing your hat of founder at Funding Options, and we'll come back to what being a former founder is like. But then we had this little sort of COVID-y thing, and I thought a nice way to lead into this conversation today would be to carry on the private conversation that you and I were having after the last time you were on the podcast, when we were walking over the Millennium Bridge. You were very keen to see me off the premises, which is very kind of you, and to make sure I get out the front door. And I was saying that, and this must have been back in something, 17, 18 or something like that. I was saying that I thought that there was a terrible wave of sort of insane Puritanism coming our way, and you said, oh no, it's just a blip. It's a PC blip, and I think the reason I was quite confident at the time was my kids were sort of sixth formers and that, and you get more exposure. Yours were a bit younger and they hadn't. So in the meantime, what you thought was a little blip on the road has turned into the, I think what one might sort of accurately summarise as the complete destruction of Western civilization. So I think I was sort of rather right on that one, and you were completely wrong.
Well, I think you're making something of an intellectual leap there.
Surely not.
Not like you, Mike.
Anyway, just teasing you, I think I shall leave it, as I said last time, which is that let's see in a few years' time. So if we're a smouldering heap in Europe and in America in a few years' time, then I was right. And if we're a New Jerusalem, then you will be right. Anyway, going back to the other element of that conversation, that you were what is known as a founder then. You're not a founder now.
Well, I am still technically a founder.
Oh, you founded, that's true.
Yes, I founded, yeah. I am technically a founder.
I founded, I conquered.
And indeed, I remain a minor shareholder in the company I founded. So you're always a founder, right? That never goes away. But I'm certainly no longer chief executive of the business I founded. I left Funding Options about 3 years ago. So it's been quite a while now. But I remain a founder.
Well, I thought one useful thing would be to ask you what the pros and cons of being a former CEO, founder, or whatever the appropriate phrase is, or former sort of full-time entrepreneur, however one might put it. Not least of which because there's a hell of a romanticisation of founding in the first place, even though the likes of Peter Thiel point out that you'd have to be nuts to be a founder, because it ain't no easy journey in the slightest, and that whilst the majority of people do the sensible thing and don't found per se, although they found their lives and they found their marriages and they found their families, so everyone founds and creates something. The reality is the vast majority of people who founded are no longer in entrepreneurial roles, and it's actually not something that I've really seen discussed at all, as if there's some kind of musical chairs and you're no longer in the game, and the sort of the kids that got out of the game have got to go and sort of stand in the corner. But I assume that there are pros and cons to no longer being a founder CEO.
Yeah, 100%. And look, I mean, I actually actively thought about whether to get back in the game as a founder, actually. I was lucky enough to have a few months off immediately after I left Funding Options, and that's one of the things I reflected on. And actually, there's a plausible world in which if I'd come up with an idea that I really thought was, a banker, there's a plausible world I would have done that. But to answer your question, being a founder is just dramatically harder than you ever realise. It's the other side of the kind of what people say is that it's going to take twice the money or 3 times the money and 3 times the time to found a business. Well, that's easy to say from the outside in, but when you're the one living and breathing it, that is enormous amounts of trauma. It really does weigh on your mind. It's what I'm basically saying is that the highs are higher, but the lows, believe me, are a lot lower. Nothing comes close to not knowing if you can pay your staff, tomorrow. Yeah. Nothing comes close if you're in a salaried job to that level of stress. So, yeah, I don't miss that. But the other side of it is that, there is an enormous sense of pride, when you walk into the office and, towards the end of my time at Funding Options, there were like 80 or so people in this amazing office. But above all else, you'd walk in and there's just this energy. And we had amazing satisfaction amongst employees. There's a real sense of pride, particularly as a sole founder, that entirely exists because of you. And, you forget that and then just sometimes it just hits you. So the highs are higher, the lows are lower. But I now have a proper job. My life is my quality of life is dramatically better.
You presumably sleep better. And it's interesting that you said that because I've heard the sort of similar thing in the rare conversation in the past, which is it's not so much the thing that you get in the media, which is funding and rounds and price and unicorns and all that kind of jazz. But it is the social ties and the social responsibility to a bunch of folk who've got their lives out there and whose day is certainly going to be ruined if you sort of have to go outside the door and say, sorry guys, we've run out of money, it's all over, because there's devastation.
Yeah, and I think the unfortunate reality is that the whole sort of VC industry is predicated on it being necessary for founders to fake it till they make it. So, there is this kind of phenomenon which is not driven by people's egos. I think it's driven by the structure of how the funding market works, right? That we're all meant to go and tell the world how we're killing it,
It's a very American thing.
It is a very American thing, but it is driven by the fact that success begats success, right? So, I spent a lot of time with early stage founders in the time I had off after Funding Options, actually. And I like to think I must have spent time with more than 50 different founders, early stage founders, and I like to think in a few cases I really helped them move the business forward. But actually in most cases where you feel you add value is basically just telling them, that it's actually quite normal to be going through the challenges you're having, right? And if you benchmark yourself against the press releases of your peers, the only thing to benchmark against their press releases is your press release, and how much gloss there is in your press release. So I think this kind of fake it till you make it mentality, and with me and Funding Options, by the time I left the business in a really good state, right, there was no more faking, but certainly you had to do that in the early stages, and I think that does kind of create this almost envy. And I remember I had a moment, right, so Funding Options was actually operating in Shoreditch back when Shoreditch was really small, as the tech hub. And I remember going to this pitching day of fintech startups really early in the journey. I'm not sure I'd even started by then. I remember being incredibly envious of a lot of the startups. And then you move forward 5 years, you're reflecting, and actually most of them had died along the way, right? And so there's kind of a survivor bias where you're envious of the ones that got through. The reality is, right, the simple fact that my business was still around meant that I'd beaten actually most of those 10, albeit some of them had gone on to amazing things. So it's just the reality of being a founder it's far more brutal than people realise.
Yes, I'm sure that's the case, and I've heard similar stories myself. I mean, it's in terms of what other people are presenting. It is very much the modern world, which is very American. We've got American tech companies, and in the early days of the likes of Facebook, it slowly dawned on, your average teenager sitting at home on their own on a Saturday night, scrolling through their Facebook feed. Apparently, all of their chums were posting these sort of pictures of being at parties and all that kind of stuff, and you'd always feel a loser until you went to a party and you did the same thing. So it's just this Facebook, a face that people feel they have to put forward. I don't think it was always that way, because certainly going back a few decades, before this country was Americanized to the extent it is, it was rather the antithesis, in that you'd say how bad you were at something, and that would clearly be a sign that you were confident and you're quite good at it, which reminds me of a tale of two cultures clashing when a Tibetan Lama, a quite high-ranking Tibetan Lama, was doing a talk in America quite a few years ago. And he started off the talk, and Tibetans are very modest, saying, oh, I'm a simple monk, I know very little. And someone in the audience said, can't we get someone who knows something? So yes, I can imagine a parallel universe in which one raises money by being modest.
Well, honestly, I don't think that can exist. Right, the venture capital industry is looking for outliers. It's looking for the 1 in 10 that will grow 10 times. That's how the model works, right? So they have to be backing businesses where the founder has that extraordinary confidence, and also they must of course see something in that confidence as well. I think it's the nature of the venture capital industry, and that we've benefited as an economy from getting that kind of American-style VC. London was nowhere in technology, or the UK was nowhere in digital technology 10 years ago. These days, London is arguably the second digital centre in the world, second only to Silicon Valley. So, we've got a lot of benefits out of that kind of American model coming across, and I think we shouldn't lose that.
No, I didn't say that, and I go even further and say 20 years. But it's pretty much the VCs in the current model that we have is definitely the American model, because we had 3i from the Second World War, and they were around for decades, and it was much more the English or British model. And back in the day, Claremont Benson Development Capital, KBDC, that we invested quite a bit of money in. If you went back at long before the American VC surge over here and the Americanization, globalization of how things worked, they were much more impressed by an honest conversation with a founder who needed development capital but would tell you all the shit things that were going wrong and what he was going to do to fix them, rather than the appearance that, I'm going to be the next Uber, or I'm going to be the next sort of Google of pencil sharpness.
I don't disagree, Mike. When you're face-to-face with a VC, they want you to have a grown-up conversation about the challenges. But what I'm talking about is how you get yourself on the radar of the VC community, which is basically faking it till you're making it. In other words, sending out those signals. But once you're in a room, actually, I think a grown-up, a proper, successful VC understands that you have challenges, there are risks. If you're going for a 10 times return, right, they fully understand that some of those scenarios lead to them getting nothing.
Quite, exactly. And going back to not all founders remain founders forevermore, the other thing the VC market is predicated on is that they expect half of the portfolio to go bust, another sort of whatever it is, a third to be pretty crap, and the tiny bit to do well. And we're getting off the topic, but both you and I have heard tales where sort of VCs have actually contributed to that kind of dynamic, investing in various companies in a particular sector and, shall we say, favouring some more than the other. So anyway, so that's life as a former, not a former founder, as you correctly point out.
And potentially a founder again, right?
Potentially a founder again. But as I mentioned, Peter Thiel, he, having said that you absolutely have to be nuts to be an entrepreneur, said that the only reason for being an entrepreneur, there's only one reason for being an entrepreneur, is that there's a change in the world you want to see and you want to make happen, and it's the only way to do it. So I think it's that way round, although there are plenty of people who get stuck in the independent mode and are sort of kind of, quotes, no longer house-trained enough to work for somebody else, and they keep serially founding things themselves, largely because then they can do what they want. Anyway, so that's just a bit of context. There is an overlap, of course, between what sounds like two roles. You've got a chief product and a chief strategy officer role, or product and strategy, and maybe you can explain that. Maybe you get paid 2 salaries, or maybe the chief strategy officer just says, well, lend to SMEs, at which point it probably doesn't take up many hours on the average day. But tell us a little bit about, from your perspective, funding options for those people who don't listen to the podcast. We're very much involved helping SMEs find alternative sources of finance, or indeed finance in general. Maybe tell us a little bit about Allica Bank for those people who don't know about it, and then also, then a bit about SMEs.
Great. So Allica Bank is focused on a particular part of the SME population that we internally would call established SMEs. So let's just break that down a bit. In the UK, there's about 5 million micro businesses, really small businesses, the SME, and there's about 500,000 or so medium-sized businesses, the M. And then above that, there's a few tens of thousands of mid-sized businesses, as they're typically called, which are like small corporates. So we're focused on the kind of middle ground, the M in SME, which we, as I said, we call established SMEs. So why are we focused on that segment? Well, the reason is because that segment is kind of chronically and structurally underserved by the incumbent banking market. There's a reason for that, because if you're a big high street bank, I won't name names, but we all know the big high street banks, you're going to make the vast majority of your revenue from two polar opposite segments. You've got your consumer segment, where you're targeting 30 million homogenous households with simple needs at a very high volume. So you've got this high volume, simple segment. And then at the other extreme, you've got corporates and public sector, which are very large, high value clients. Each one is bespoke, but you don't care because the revenues from each client are so big. And you kind of throw relationship directors at them, what they call coverage within banks. The medium-sized business segment is kind of stuck in the middle. So they're quite complex, but they're not as high value as corporate.
And just to clarify one bit about the use of the word medium to help the audience understand, when you say medium, what do you mean in terms of, I don't know, annual revenues or number of staff?
So annual revenues would typically be in the millions or very low tens of millions. So that's kind of what we would consider to be medium. So a sort of micro business, a small business, would typically tap out about £1 million of turnover. So I'd say that our sweet spot is probably a few million turnover. And the crucial thing here is that the micro business segment, well, there's really two things. Firstly, those really small businesses are quite simple. They're actually quite consumer-like. There's typically one person authorised on the accounts. When you're lending them to them, you're just as interested in their personal credit rating as you are in the business. They're quite simple. And as a result, the big banks can service those small businesses, micro businesses, on a consumer banking platform.
As if they're private clients.
Exactly, yeah. But the medium-sized business segment, you've got, well, for the technical people on this, you've got OpCos, PropCos, you've got PSCs, UBOs, operating companies, property companies, people of significant control. You've got directors, you've got registers and trading addresses. You try and put that complexity on a consumer banking platform, everything breaks down. So historically, how the big banks would have dealt with that is they would have had Captain Mannering. For those that are not British, they have a traditional bank manager in the branch. And that person would effectively just brush over the cracks. So if the customer needed to change their trading address and the system didn't understand a trading address versus a registered address, Captain Mannering would step in and sort it out. We've now lost the branches, we're losing the bank relationship managers. So that kind of sticking plaster of throwing people at the problem is disappeared, and the operating costs just don't make sense for the big banks anymore. So you've got this segment that's stuck in the middle. So what we're doing at Allica Bank is building a highly focused and dedicated operating model on that segment. And the bit that's missed, particularly by the VC community, investor community, is that they actually really like the micro-business segment, but the micro-business segment's actually economically really small. Yeah, it's barely 10% of the economy. The medium-sized business segment is about 30% of the economy. And from a financial services revenues perspective, it's an even bigger gap, because a micro-business can't sustain meaningful debts. They're probably going to use personal credit cards for, to buy their stock. A medium-sized business is a significant business with significant assets. So the financial services revenue pool from the medium-sized business segment is much bigger than the micro-business segments. But for some reason, the VC community has yet to discover it, thankfully for us.
So is it, metaphorically speaking, or maybe even non-metaphorically speaking, effectively the lending equivalent of the funding gap in equity terms? You fall between the two stools. You're not a fish or a fowl.
Exactly. And look, we all read in the newspapers about the banks not funding small businesses, as they tend to get called in the newspapers. The reality is, as always, there's nuance there, right? And it's actually that middle of the market. The example that's always given, which is largely turns out to be true, if you're a big high street bank, you can either do one £10 million mortgage for one large corporate company that wants to buy its premises, or you can do 10 £1 million mortgages for 10 small shops, factories, whatever they may be here. Operating costs for you, because you have an inefficient operating model that's not optimized for the segments, is about the same. Okay, so you will always drift towards the larger ticket sizes. And we've seen this relentless retrenchment over time of the big banks from lending to medium-sized to our sort of established SME segments. It's a structural thing, which is why it's such a compelling opportunity. And because the big banks struggle with it, we'll come on to this later, I'm sure, but you want to be in a lending pool that the big banks don't want to fight you for, because they have many inherent advantages if they choose to use them.
And when you say the big banks, the high street banks, the commercial banks, clearing banks, as what? Where does one fit in, not so much fintechs, but definitely neobanks like Aldermore and the spate of banks that got formed a while ago and made it £1 billion? Yeah, in terms of the competitor landscape.
I would characterise them as sort of the first generation of challenger banks in the SME segment. They typically came about after the global financial crisis, where I'm sure we'll get into the second, but actually a recession, as unfortunately it feels like we're about to go into, tends to be a positive for new lending challenger banks, because the incumbents are focused on working out their existing portfolios. So the lenders that you're talking about, kind of first generation, we certainly see them as within our peer group, but there's some key differentiators above all else, our heavy use of digital, where we think in the end, to really play in the core of the market, You need to have an operating model that it is a generation ahead of those challenges, and indeed 2 generations ahead of the incumbent banks.
Yes, and I didn't really cover any of them on the podcast, largely because they just seemed to be new banks. I mean, there was nothing particularly fintech about them insofar as they used computers and all that.
But you know what, Mike? They're not fintech, but there is a really important nuance that the fintech market has completely missed, and this has been the death of billions of pounds of VC capital, right? If you look at the lending market to SMEs, if you break down let's say 200 billion or so of lending stock in the UK, all the fashionable VC plays, which are kind of these data-driven digital lenders, are playing in a pool of about 10 billion. So they're playing in a pool of about 5% of the market. The core of lending to SMEs is to establish medium-sized businesses, and it's typically asset-backed. So it's typically lending against your property. So let's say you're a shop and want to buy your premises. You're a warehouse. You're a transport business. You want to buy a warehouse. And it's against your assets, which would be your vehicles, your machinery, and also against your working capital, your receivables. And actually there's these constant attempts by VCs to try and enter SME lending, not understanding the fundamental point that the core of the market is prime secured lending, where you have to have a bank license to be able to access that, because these are not customers that are happy to pay 20% interest rates, the kind of things that are common in the short-term unsecured lending market. So far, fashionable investment VC-backed plays have basically played in a very small pool because they're structurally unable to play in the big pool.
And this represents the usual challenge that there's a spectrum of subdomains of most markets where, quotes, the computer can do it on its own. I don't know, think of an example, but Canary Wharf, having mentioned Canary Wharf, there are sort of residential buildings nearby and the apartments in there are virtually identical, and therefore you can, quotes, price them on the computer. The avenue that I live in, roughly no 2 houses are exactly the same shape at all, different numbers of bedrooms looking different directions and all this kind of thing, and you absolutely couldn't price that with a computer. So there's a spectrum between where, forget the computer, an algorithm can do it, and where you need more expertise.
And you know what, Mike, that's where the magic lies, because the problem with the incumbents is they've not taken digital as far as you can go in that segment yet. So just to unpick your analogy, right? Your house, I imagine, is worth quite a lot of money. Using human beings at some point in the process, bringing in that sort of expertise at the final stage of the process, can be very cost effective and certainly lead much better underwriting decisions. But to deploy those human beings, you've got to make sure they're not doing admin. Yeah, they're not collating stuff. They've got all the information they need. So the trick and the magic lies in actually using technology to make sure, if you're going to use those human beings for those high-value lending decisions, which are very profitable with the right operating costs, because they are large loans, the trick is to use technology as much as possible, but then the final decision goes with the human being.
So it would be, mixing our metaphors completely, it would be a bit like you have a high court judge who makes good quality decisions. You don't want him busy finding all the papers for himself. You want to sit him down in front of a folder, which is in a set way that he recognises it. He flicks through it, said, I've read ahead of you, I've read ahead of you, I've read ahead of you. Yes, this seems to be this. I've got this question, this question, this question, and that's a decision.
And because our segment of the market, certainly amongst the incumbent big banks, has been so underinvested in, there's still lots and lots of paper-based stuff, right? I mean, a lot of these big banks only adopted e-signature because of COVID, right? So they sat on it for decades, literally decades, until they actually finally got around to using technologies that make stuff efficient. Coming back to my structural point about the 2 big revenue centres of big banks, almost without fail, what will happen every year in a big bank is about this time of the year, the SME division will be coming up with its budget. They will have been told, this time round, we're actually really going to invest in SME. You're going to get your £50 million. And then between now and the end of the year, when they fit the budget, something will happen. There'll be a regulatory blow-up, new regulation. They'll find an anti-money laundering and consumer division, and that money gets taken away. So relentlessly, they underinvest over time, which is why they're so manual and paper-based and unable to compete.
Right. So there was a clear opportunity for tech to come in, but as you say, the whole process to be capped off by somebody with expertise and experience who can see beyond the numbers. Okay, so in terms of lending to the in SMEs, and as you've outlined, combining technology to ensure a good quality flow of appropriate data and then using the human being to cap it off, there are, amongst your cohort of fintech founders back in the day, a whole bunch of ways of doing lending. You can have, as our former guest on the show did, a fund. You can raise a bunch of money and just lend out the money from the fund. JDev was on a few months ago talking about Zopa's entire journey from 2005 to today, from inventing peer-to-peer to now no longer being in it at all, having closed the PTP down and become a bank. And then there's, of course, the likes of Funding Circle, who are now listed and remaining relatively true to peer. I don't know how much is actually retail money going in as opposed to larger chunks of it.
These days, none.
I would have guessed that, and they're not far from being an iWalker, who are obviously the people I was relating to before. So one of the things about fintech, just from a sort of a banking-y, lending-y perspective, is that various models have kind of come, and some of them are kind of gone, and some of them have kind of waned. So why is it that you guys, having seen the analysis you present and the gaps in the market, why did you feel that the right way to address that was to be a bank, with all the complexity that being a bank involves in terms of, T-size, the balance sheets, maturity transformations and all that jazz, plus these days an absolute megaton of regulation? And as I was saying to the prior episode's guest, when Sir Paul Tucker was on the show, he said in the 1970s the Bank of England had no responsibility for banking regulation, and indeed there was none. They kept a bit of an eye on it, so the world has changed a hell of a lot, and it's certainly much more hard work in terms of compliance departments being a bank in 2022 than it was in, say, 1982. What led you guys to think, okay, there is this gap in the market, they need a few quid, if you have technology and people done well, that'll do it well, at which point you've still got the question of, okay, so why did you then decide the best way or only way to do that well was to become a bank per se, with all the downsides as well as the upsides, as Jade has covered about Zopa?
Yeah, well, we have this unfortunate thing that happens at the moment, which is the term neobank is often used to describe non-banks as well. So look, if you're offering just a current account or a payment account, then there's no point being a bank. There are regulatory structures that allow you to do transactional banking, like current accounts, without a bank license. The reason to be a bank is to lend. Yeah. Now, why is that? For those that don't know, it's because a bank can be a custodian of retail deposits, individual people's savings, and it pays interest on those, and it's able to, the interest it pays is much lower than, for example, if you were to get a funding line as a non-bank lender. So it's all about being the custodian of those deposits, and it's exactly because you're that custodian is why the regulatory bar is so high to be a bank. It needs to be. Let's be clear about that. So the reason to be a bank is the ability to lend with a much lower cost of funds than a non-bank lender who actually, frankly, has to borrow the money from a bank to lend on. So that's the reason to lend. I think the really interesting topic, actually, because what I just said is not a new insight, but the really interesting topic is where you can actually build a successful new challenger lender bank. So let's just unpick that a bit. You've got to find a lending pool that is big enough to support a bank license. So in other words, that the economics of the cost of being a bank are justified by the fact you build a balance sheet with a cheaper cost of funds. So you've got to find a big enough lending pool, but at the same time, it can't be a lending pool that the big banks love, because they have an advantage on cost of funds. So a big high street bank will have billions of current account money flushing through their accounts that they pay no interest on. So if they choose to fight a price war against you as a challenger bank, you're going to lose. Yeah, because it's the challenger banks that you'll typically see on the tables about who offers the best interest rates.
And that was the case for Zopa. Zopa was never the cheapest place to borrow money.
Yeah. So therein lies the challenge. So, for example, there are challenger banks, believe it or not, that play in core residential mortgages, so mortgages on your house, my house. If you're playing in a non-specialist segment, in other words, the generic area of the market, you are inevitably going to get fight a price war with big banks, and you will inevitably lose. So areas like commoditized retail mortgages, bad idea. So you need to find that a relatively rare thing, which is a large pool of specialized lending, where the big banks aren't very competitive with you. Because so a good example would be you don't want to be in retail buy-to-let, which is highly commoditized. But professional buy-to-let, for example, so people who own lots of properties or own what are called HMOs, these large student accommodations, for example, that's a specialist market. The big banks aren't very active there, so you can still get margins. So the trick is basically finding a large market, but a large market that the big banks won't fight you for. And that's actually, that's a very good characterization of Allica's market. We talked earlier about why they struggle with our segments. But it is a large lending pool, about somewhere between 150 and 200 billion pounds of lending stock, which is plenty on which to build a really successful and large bank.
And in terms of the lending, you mentioned obviously the relevance of secured lending. What percentage of your lending is secured?
At the moment, a very large proportion, because a lot of it is secured. Well, and we prefer secured lending, right? The kind of businesses we're lending to are businesses that typically have significant assets. It's predominantly secured, albeit we don't have anything against unsecured lending, but we don't want that to be, we certainly don't see that as being the core of our business.
Yes, and I was remembering an ancient Christmas party at Grosvenor House back in the day when the chairman did his usual Christmas speech, this is when the whole bank would fit into Grosvenor House. And he made the blindingly obvious point, but it did stick in my mind. This was after the 1 year in which the banking division had taken a bath, which is that it's all very well lending money and making 1 or 2% on it, but then you lose 1. You've got to do 50 more just to get your money back. So one of the challenges of the bank is, of course, what your credit performance is. And I think it's one area that they've done amazingly well, actually, in that their credit losses remained relatively low, because the margins, even if you find an area which is relatively underserved, you're not taking 10 or 20% out of it. It's not like you can afford 1 in 5 of your portfolio. I mean, as we were discussing before, VCs can afford 7 out of 10 to go bust, because the upsides in the other are so big in this sort of globalized model. But if you're making, let's make say 5, and that must be a reasonable deal. You're making 5% on some secured loan. Well, if 1 in 20 of those go bust, it's going to spoil your whole year.
Well, if it's secured, by the way, important point, it is secured, not so much, right? There's what's called the loss given default. So in other words, the security is there. I mean, you talked about the sort of 1 or 2%. That's a good description of residential mortgages. And residential mortgages, the key point there is basically if you fail to repay, then the bank has your house, right? So the loss given default, in other words, the bit after they've actually used the security of collateral, tends to be a lot less, which is why retail mortgages, for example, tend to be so cheaply priced. Yes,
that's true. And we could certainly have a whole episode itself on, which we've never done so far, it'd be a bit too techie in the banking FS sense, on collateral, because rather like everything being fractal complexity, I mean, Africa, as I was talking about in the previous podcast, was fractal complexity, SME is fractal complexity, you can see zooming in, and collateral is a word which covers a million different sins. And again, having seen various bad bank portfolios over the years, just in terms of life in general, there's all sorts of cock-ups that people don't see coming that they then trip over in various bear markets. Right, okay, so I like your segmentation into the sort of more micro, the medium, making a few mil turnover or small 8-figure numbers, and then above that, the top end of the SMEs, you've got basically the small corporates. I take your point about the micro businesses basically being able to be addressed pretty much as private clienty ways, and then the larger ends just about being caught by the banks, depending on whether the tide is going into the middle. So there's a gap in the middle. You've explained the reason for being a bank. I mean, the one thing that strikes me here, relevant to what Jadev's point was about Zopa becoming a bank and giving up the peer-to-peer, which is, amongst other things, the cost of customer acquisition is so high that just having one product to sell them, which might be a car loan, and then they don't need it and don't come back for 15 years, you've got a lot of marketing costs per customer, and you haven't got the cross-selling. So maybe you might just address that issue as it applies to SME lending, because you might have the same thing. I mean, the London Fintech podcast might grow and become the size of several million turnover, and I need a loan, but I need a loan for a few years, and then I go away and don't need one. And unlike Zopa, who can now sell you credit cards and a whole bunch of things, do you not need, going back to your neobank model, do you not need a portfolio of products to offer? And then a little bit of wrap up about how you see the future going in the next few years, which certainly look like quite a challenging one for all segments of the economy.
Yeah, so in terms of where we're going, your cross-sell is bang on. So it's in the public domain that Allica is building a full-service bank for for established SME businesses. So what that means is, unlike the first generation of challenges in our world, we are actually building a current account. We'll be talking publicly more about that very soon. And we also have a growing range of lending products as well. So we are about building a relationship with the customer, not just being a specialist lender that happens to have a bank license. Our current account is super exciting. I've been personally heavily involved in that from its inception when I joined the bank. So we are building a full-service bank. We have, something that's been unfashionable for the last few years, but is now very fashionable, is we have very, very compelling unit economics. So we'll be talking publicly soon about our financial position, but suffice to say that we are very confident in terms of our economics. And we recently hit £1 billion of lending, so we're on a really strong trajectory there as well. So from an Allica perspective, we're building a proper challenger to the big high street banks in this segment. That's what makes us different. We believe that there's time and need for a real challenger to go out and actually face them. So that's Allica. We are, of course, in very challenging times. So typically a new lending entrant or new bank lending entrant, that tends to be a positive because the incumbents tend to be retrenching from the market. I say that with no joy, but it does tend to be positive. But obviously we're all very mindful of the fact that the SME population has already taken a huge strain through COVID. There was a lot of government-backed debt there, which is now beginning to run down if you look at SME balance sheets. And of course, we now have the extraordinary situation in terms of input costs, in particular energy costs. So, I don't have a crystal ball, but this is clearly a difficult time ahead of us.
Indeed. Well, the one thing about the future is that it seems to arrive on its own. As long as we all keep going to bed and getting up the next day, the world seems to change on its own, and we gradually find out a little bit more every day. So before we wrap up the show, I'd like to thank all you listeners out there, my brand partners of the podcast. Smart is transforming pensions and retirement worldwide. Their leading-edge retirement tech platform propelled them success in the UK. Now they're operating on 4 continents and working with partners like Zurich and JP Morgan. Find out more at www.smart.co. The enlistedboard.com, your guide to entrepreneurial governance and how you can start making your board an engine of growth today. So you've mentioned Allica Bank once or twice. In terms of your coverage, you're Britain only, are you at the moment? And do you have a regional sales managers or something? How does it work? Or do you all just sort of sit in the city and wait for people to come to you? How many people have you got at the moment? And
we do have some regional coverage. So we have some relationship managers around the country, and we also have a team that face off to the introducer population, which would be the likes of brokers and accountants. So we do have coverage across the country that gives us the ability to actually be closer to the customers.
And roughly how many staff?
We're coming up to 300.
Oh, that's quite a number. And I've lost track, if I ever had a track, on how much money you guys raising.
Yeah, so at the end of last year, we announced that we'd raised a little over £100 million of additional capital. And actually, since then, we've also announced some further fundraisers as well. So we're on an exciting trajectory, and we will be raising money at some point in the future.
Right. Well, that sounds pretty substantive to me. So in terms of being even bigger and better in the future than you are today, what would you like to shout out there in case any of the listeners have it or are it in terms of making you even more mighty?
Above all else, what we really would like is talented and ambitious people. We're growing really quickly. From a purely self-interested perspective, my world, what I would desperately love is more amazing data people, product people, technology people, design people. So if you're looking to join a sort of ambitious, high-growth business, with a really great culture as well, then please do reach out.
Excellent. Well, as listeners will know, I'm a great fan of the SME sector, and as I've mentioned on many podcasts this year, we're one way or another in something of an age of destruction, and going back to founding, the only act of creation in the economic society is by founders founding something better. Otherwise, you're getting incumbents who evolve, as we were saying in your particular case, but it applies across all the other fronts of Fintech very slowly. So it sounds a fascinating journey you guys are on. I hope you weather the storms well, and I hope in weathering the storms that you help your clients weather the storms too, and that at some point in the future, the sunlit uplands reappear for the economy. And I wish you and Allica every success in the future.
Thank you very much, Mike.
Thanks for listening. If you're in need of a non-executive or advisory director with deep expertise, experience and contacts in the worlds of both traditional FS and Fintech, or unique insight into how to make your board an engine of growth today, contact me at mike@mikeballiman.com. If you just need one-off advice in these areas, via clarity.fm/mikeballiman.
We could sit in a bender all day, watching the firelight dance, watching the firelight dance. We could walk in the mountains before dawn, watching a happy moon ride, watching a happy moon ride. Come away from the city with the tarmac so dead, and the people so sad. Come away from the city, with the faces so grey, with the pain of the everyday. We are wild like the mountains and the trees. Can you see what I mean? Can you see what I mean? We fade in between the earth and the sky. Kiss the city goodbye, wave the city goodbye, wave the city goodbye. The city goodbye. Watch the firelight dance with me. 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 Watch the firelight dance.